Did you know that there are actually buyers running around out there right now shopping for a home, but they don't even actually know how much home they can afford? And this is because a lot of buyers these days start their home search process online by simply typing in Google, how much home can I afford? Which then takes them to an estimated home affordability calculator where they simply guesstimate on their income, their expenses, maybe even the amount of money they have in their account, right? And then out spits a pre-qualification letter that says, hey, congratulations, you've been pre-approved for X amount of dollars. And then the fine print, which nobody ever reads, says, hey, by the way, this is not a guarantee. Nobody actually looked at any of the information you provided or verified that you're actually working or you actually have this stated income or your expenses, or maybe we didn't even run your credit score. But they simply take this pre-qualification letter and they run with it. So they take it to their real estate agent. Hey, check this out. It's amazing. I got pre-qualified for this amount of dollars. Now we're all good. Let's go shop for a home. And so the worst thing is they go under contract. They pay for the inspection. They pay for the appraisal. And once you go under contract, now your loan goes into final approval, right? Through the process, where somebody does finally start looking at your income, your documents, your expenses, your credit score, your debt to income ratio. And believe it or not, sometimes it turns out, oh wait, all that information you gave us, it's not accurate. You can't actually afford that house. And so your loan gets denied. All that money that you spent, all that time that you spent, all gone for nothing. Don't let this happen to you. That's extremely heartbreaking. So that's why you're here watching this video, so you don't make these same mistakes. So how do you know exactly how much home can you actually afford? Well, you've arrived at the right video. Lorvang here with the Move Smart community. Not only am I a licensed real estate agent in the state of Wisconsin, but I'm also a licensed mortgage loan officer in Wisconsin, Minnesota, and California. And in today's video, I'm going to share with you exactly how we as loan officers help you to determine how much home you can actually afford so that you can shop with confidence. Okay, so let's get right into it. How do we determine how much home someone can actually afford? And what we're really trying to look at here is someone's complete financial picture. So we're trying to compare how much recurring major debts does someone have compared to their gross monthly income that they bring in. So while your income number is important, it is also equally important how much debt are you carrying around right now, right? The income portion is somewhat pretty easy. We're looking at your gross monthly income, but however, it can be pretty complicated depending on what type of job that you have. If you are a salary W-2 employee, super simple, right, to figure out your monthly salary. If you are straight hourly, that's also pretty easy, but it does get more complicated if you have shift differential, if you have like bonuses, or if sometimes you gotta work as a nurse in charge, right, where you get paid more. And so if it's more complicated, then you might just want to reach out to a loan officer and have us help you. If you are a self-employed person, then your business does need to be operating for more than 2 years. You also need to supply 2 years worth of tax returns. And something to really keep in mind that is really important if you're self-employed is that you need to really account for your net income, right? So your net reported income, not so much just, oh, here's how much income I made for the entire year, because a lot of self-employed people, right, you're going to write off a lot of your expenses as deductions. We really can only qualify you based on your reported net income. If you're trying to buy a house, something to think about. Maybe you shouldn't write off so much of your expenses, right? So it can get pretty complicated there. Now, let's take a look at the debt portion of things. Okay, so on the debt side of things, we're really going to be only concerned about your major recurring monthly debts that you're going to be paying for quite a while. So could be possibly things like a car loan, student loans, personal loans, credit cards, right? Major credit card debt, right? That's what we're concerned about. Possibly also alimony, child support. We are not concerned about your Netflix or your cell phone bill or even utilities, and also not your rent. because the purpose of getting the pre-approval so you can buy a house is to replace the rent with that new mortgage payment that you'll be making. And so we are going to be including that new future mortgage payment into this debt to income ratio calculation. So there is a magic number that we're going to try and stay under. Most of the time, we're going to try and stay under 45%. There are some other loan programs out there that you could go up to 50% and maybe even a touch higher than that. So if you're going to go with an FHA loan, that is going to be around that 50% mark. But if you are just trying to estimate, right, without talking to a person like us, then you may want to be more conservative and just use that 45% number. All right, so now that you've got the basic understanding of DTI ratio and how we like to see a borrower's financial picture so that we can determine how much home somebody can afford, let's put some numbers to this so you can make it a little bit more clearer for you. Let's start off with some easy math here. Let's say that you make a gross monthly income of $10,000 a month. And let's say that we've added up all your debt and you're only carrying around $1,000 per month of monthly debt. And so at this point, without a new mortgage being added in, if we divide 1,000 by 10,000, that's going to get you 10%. So at this point, you only have a 10% DTI ratio. Now, if we're going to max this out, right, remember that we want to keep that DTI ratio to a max of 45%. That would mean that at most, you could be carrying a total monthly debt expense of $4,500. And so if you're only right now at $1,000 without a mortgage, we subtract, from 4,500, that 1,000. So that leaves you with a total available monthly mortgage payment of $3,500. So from here, what we're going to do is back calculate, like, hey, in our market, right, whatever market you're in, you're going to go use a mortgage calculator, right? And so you're just going to put in, like, say, $400,000 and what the interest rate is, what the down payment is, and then it's going to calculate out what your monthly mortgage payment would be. And of course, you just want to get as close as your max mortgage payment that you calculated from that DTI calculation. Right. And so in my market of Milwaukee, right, if I'm going to be doing that back calculation right now at, say, 5% down and let's say interest rate is 6.5%, well, I'm going to be looking at a potential purchase price of around $400,000 to $450,000 to be in that range of a monthly mortgage payment of $3,500 here. And don't forget that that monthly total payment here of $3,500, that actually includes the property's taxes and home insurance, right? So you have to factor that in as well. And depending on what county, what city that you live in, your taxes could be much different, right? From city to city, county to county. And then, of course, what region that you live in, the US, right? What natural disasters are around you, your home property insurance could be vastly different, right? From, say, Florida to Wisconsin, where I'm at, to California, where the fires are, right? So those are some important things to keep in mind. So hopefully now you have a better understanding of how we determine how much home somebody can afford. And if you're currently sitting there and thinking like, hey, but wait a minute, I actually want to live in this location in my area and I need a little bit more money. As you saw, there are some variables that go into this calculation. And so there are some things that you could possibly change to help you get there within reason, right? So of course, we started with income. If there is a way for you to increase your gross monthly income, then of course you can increase your home affordability number, right? If everything else stays equal. Now, the likelihood of you maybe getting a raise or promotion or maybe a new job, that's on you, right? How are you going to do that? The other number is to reduce your total monthly debt that you carry, right? If it's like things like credit card bills that are holding you back, well, maybe you got to start paying them down, right? Pay down those balances. If you have some loans that have small balances only, maybe it's time to pay those off, right? If you have a car loan, right? Maybe if you're close to paying off your car, then you could just go ahead and pay it off, especially if you have the funds, right? That's definitely going to help you to qualify for more home. But at the same time, there's a trade-off because you still have to have enough funds for the down payment, and the closing costs. But if you do have enough for the minimum down payment and the closing costs, then it is possibly worth it to pay off that car so that you could afford for more home that you can purchase, right? So that's some things that you can think about. Now, the other thing is that, after you get your monthly payment of mortgage that you can afford, right? Now, when you're back calculating it, right, that calculation of how much home there are a couple more variables, which is interest rate, right? Before we get to the interest rate, there is actually also the property tax and the home insurance, right? So, home insurance, it's probably going to relatively be the same in whatever area you live, right? Unless you're going to move very far distances. That you probably can't really do a whole lot. Of course, you could shop around, but most home insurances carriers are probably going to be similar. The property tax part is huge. That is a huge thing that a lot of borrowers don't quite look at. They're really looking at the purchase price of a home, but they're not really taking a close look at property taxes. And if you're a savvy buyer, you're looking at city to city, county to county, which ones have the lower taxes, right? That can definitely have a major impact on how much home that you're left with for that purchase price, right? And then lastly, we're coming back to interest rate, right? So when interest rates do reduce, they go down, that increases a borrower's ability to purchase. So how do you, besides just waiting for interest rates to go down, how can you make interest rates go down? How can you do that, right? Well, potentially you could buy down the interest rate if you have the funds to do so, right? So you can do what's called a permanent rate buy down, or you can do a temporary rate buy down as well. There are other things like special loan programs. I know one right now that's currently a lender's offering a free first year interest rate 1% reduction right off the bat. And so that can totally get you a more affordable payment right away. But at the same time, that's just a temporary. So that may not have too much of impact, right? So what you're really looking for is more of a permanent rate buy down. There are other programs, loan programs you can look at as well that might have a lower interest rate, right? Such as ARMs, right? An ARMs loan. Sometimes, depending on what those rates are for ARMs, it could significantly be much lower than conventional. So that might be something you want to explore as well. Of course, that's a topic for a whole nother video on pros and cons of ARMs loans versus fixed rate loans, right? And so those are the variables that you can use, the levers that you can play with to kind of adjust how much home you can afford. Actually, before I forget, there's one more way that you can reduce your interest rate, and that is by increasing your credit score. So when you have a higher credit score, you can qualify for a better interest rate, right? And so how do you go about increasing your credit score? Well, that's by paying your debts on time, right? So don't miss any bill payments. And then also helping out by paying down your debt balances, right? And so, of course, if you are doing both of those things, reducing your debt that you're carrying every month, that's going to improve your DTI ratio, and it's going to improve your credit score. So both of those things together will increase how much home you can actually afford as well. All right, now you got enough information to be dangerous with. You can go out and calculate your own home affordability numbers, or the better advice, leave it to the professionals. Find a loan officer like me that you know, you like, and you trust, and let us do the work for you. Send us your pay stubs, send us your W-2s, your bank statements, right? Let us pull your credit. We're going to review your DTI, right? So we're going to really help you calculate, especially if you have more complicated income, right? So that you can actually shop with confidence with a real solid pre-approval, where we're going to run your file through our automated underwriting system, right? So now all you need to do is go find a property and get that under contract, rather than risk it and just go through and use a 5-minute pre-qualification letter that you got from some online website. So if you are in the states of Wisconsin, California, Minnesota, feel free to reach out to me. I can help you run your numbers. I can do it free, no obligation. And I'm with Next in Lending. So I have over 270 plus lender partners. I pull your credit once and I can shop across all of those 270 lenders, find you the best program as well as the lowest rate for your unique situation, because the truth is everybody has a different financial picture, right? So my contact information will be on the screen as well as in the video description. So if you want to hit me up, feel free to reach out. Otherwise, if you got value out of this video, if you can please do me a huge favor, show me some love in the comments, hit that like button, please share this video out there so that anybody that you know might also get value out of this and help spread the word so that buyers out there can get started on their home buying journey the right way. So thank you so much for watching. I'll see you in the next one.